I'm Susan Sarava with Comerica's marketing team, and I'm joined by Bob Buchanan, who heads up our business transition planning. Bob, welcome. Good to see you.
Thanks, Susan. Great to be back.
All righty. Today we are talking about ESOPs, employee stock ownership plans. So this is going to be a great conversation for business owners who are considering some options for themselves. So I'm going to ask you, what exactly is an ESOP?
It's a qualified plan. It is something that is regulated by the government through ERISA, the Employee Retirement Income Security Act. But in more practical sense, ESOP is a way to sell your company to a buyer that you create yourself. And you don't have to sell the whole company. So there are some governmental regulations around it, but it's a very flexible buyer of the stock of your business.
Okay, well, it can be a great option for some business owners. We're going to talk a little bit more about it. But first, let's go to this slide that we always start with. And this is about the fact that we know a lot of business owners are going to be making a transition over a 10-year period. Tell us more about that.
Yeah, so the study that comes out every couple of years, and it's very consistent over time. And what it tells you is that more than 50% of business owners will be transitioning in some way over a 10-year period. At least that's what they say today. What's really interesting about the slide is the timelines and the number of people who think that they'll never transition, right? So something like 7% every year, 7 to 10% believe they'll never transition from their business, which simply isn't true. All business owners will transition at some point, whether they do it the way they want to or they do it the way that they don't want to. Sometimes that transition comes at their death. I mean, if you haven't planned well and worked through it, it's not the transition you want. One of the things that isn't shown on this slide, the same study talks about the number of people who want to leave their jobs over the next 10 years, business owners who don't want to work any longer. And that number is significantly higher. It's 81%. And so if 51% think that they're going to transition over a 10-year period, 81% are going to stop working, then maybe there's a problem in the definition of transition in their mind, because when you stop working, that is a transition. But anyway, I find the slide very informative, and it's something that we should all be thinking about, because the number of businesses represented by that 51% is hundreds of thousands. It is just an astronomical number, and the economy drives from these businesses. And so when that many people are thinking about transition, it can have real economic impact.
Okay, that makes a lot of sense, Bob. I always wonder about that part in the pie chart that says never, because never is not a plan. So it's good that we're having this conversation.
Yeah.
All right, many ways to transition. We're going to go through some options that people have to transition, and tell us what those are.
There's a lot of ways to transition, and they're not all captured here. These are the sort of typical ways that private business owners transition. You know, some people can take their company public. There are lots of options out there, but typical ways are selling your business. People sell their business to outside buyers. They sell to strategic buyers or to financial buyers, typically private equity groups. You can keep your business and transfer it down through your family. And so often that is a plan, and there are a lot of family-owned businesses that are multi-generational, and that's a plan that we see very often. You can keep your business and just become an absentee shareholder, bring in professional management. That's a transition alternative. You can sell to employees, key employees, or to a broad base of employees, and that's what we're really going to talk about today, is ESOP transactions, where you create an employee stock ownership plan and you actually sell your shares to this plan. But when it comes to transition, there's no one type of transition that fits everybody. But there are some that are more common. And when we talk about an ESOP, this is one that is fairly common, not as common as selling outright, but it's one that's extremely flexible. And so it's actually becoming a more and more common event to create an ESOP and transition that way.
All right, Bob, let's go back to the financial requirement. Before we left, we were talking about the fact that financial requirement is a really big piece of the puzzle here. So explain more about financial requirements.
So I always tell people this is the place to start, because any transition plan will fail if the plan requires a dollar amount that it can't achieve. And so the first thing that people need to do is understand what their personal financial needs are going into the future, really forever through their estimated lifespan. And once they've done that, then they have to look at what they have and what that gap is. And if there is a gap, there's not always a gap. So sometimes they have enough and everything they get from their business is just gravy. But often there's a gap, and that gap has to be filled some way. So it can either be filled by selling the business and getting proceeds from the business, or through the ongoing operations. And that's one of the considerations when thinking through transition is, can I keep the company if I want to? And will that fill that gap for me over the period of time that I need it filled? Or do I have to sell the business because the proceeds will be so much more than the ongoing revenue stream or income stream?
Okay. All right, let's move on to the focusing on transferring to an ESOP. So we talked about generally what business owners need to be considering. Now let's specifically, if you want to go the ESOP route, what are some things you need to know?
Yes, this is one of the more interesting kinds of transitions because it's so flexible. So often when I talk to people about what's important to them in transition, it's not all about the money. So we talk about the financial planning piece first and filling that gap, but frequently what's important to them is legacy and their family and things like that. And so while we start with, do you have enough money and will the business fill the gap? We move very quickly to what are the real goals in transition. And with an ESOP, one of the things that ESOPs allow business owners to do is preserve their business in its current form for a very long period of time. And so when they think about legacy, often they want their company to stay intact. They want their employees to stay there. They want the business to stay in their community. They want the name to stay the same. There are all these things that are important to people. And with an ESOP, it's possible to meet all of those goals or to meet whatever other goals you might have. And so when thinking through transition, some people want things very simple, very plain, very cut and dried, and maybe a sale to a third party is the best way to go. An ESOP provides a lot of flexibility, but it's also potentially fairly complicated. And structuring an ESOP is extremely important because you need to do that on the front end so that you can preserve all of those things that you want to achieve on the back end. One of the really interesting advantages of an ESOP relates to taxes, and it's something that makes ESOPs very attractive to people. And so when we get into talking about the value you get from your business, most business sales have a tax component. You're going to have to pay taxes on the proceeds. With an ESOP, you might have to pay taxes on the proceeds, but under certain structures, and again, this can be complicated, you could avoid paying the income tax, which is typically capital gains. Sometimes it's regular income tax, but typically capital gains tax. With an ESOP, it's always capital gains, and there are ways to structure it to avoid paying that potentially forever. You can at least defer it. And then there's some really interesting tax advantages to the company as well. So, when we talk about ESOPs, we can't cover everything in a 30-minute conversation because it can be very complicated. But the things to remember are that if you have goals outside of the financial goal, an ESOP might provide the flexibility to meet many, if not all of those goals.
Okay, Bob, I want to mention we did get a question about taxation of proceeds from the sale within an ESOP. So I just wanted to mention that for our audience. If Bob did answer that question in the answer that he just gave, just let us know in the comments, or if you have more, you wanted to elaborate more on the tax part. All right, let's move on.
I can go a little bit deeper into that.
Okay.
So the taxation of an ESOP is different than the taxation of sales of other types of sales, because when they created the ESOP structure, this was a federally created structure through Congress. There's legislation that creates employee stock ownership plans and gives them preference. they wanted to encourage employee ownership as a good thing. And so they provided these tax advantages to encourage owners to sell to ESOPs and to encourage ESOP companies to be long lived. And so some of the tax advantages include the ability to defer the capital gains tax on the sale. So when you sell to an ESOP, ESOPs can only buy shares of stock, right? They can't buy assets. And so by definition, when you sell shares, you get capital gains treatment. If you sell C corporation shares to an ESOP and you sell a certain percentage of the shares of your company, you have to meet a percentage test, and it's 30%. If you can sell 30% in a single transaction and they are C corporation shares, you're allowed to reinvest the proceeds in what's called qualified replacement property. And as long as you hold that qualified replacement property, you don't pay the capital gains tax on the sale of the ESOP shares. So it's a lot like a 1031 exchange in real estate, where if you reinvest in similar property and like kind property, then you don't pay the gains until you sell that property. Well, for an ESOP, like kind property means United States-based stocks and bonds. So you can actually have a portfolio of traded, public traded securities and not pay tax on the sale from your company shares until you sell those securities. And there's even a way to have a security that's very long lived, and maybe defer the taxes forever, because at your death, your heirs get a step up in basis. And so this is getting fairly technical, maybe too technical for this conversation. But if you structure things correctly, and again, there's some complication around doing this, but if you structure it correctly, you could avoid the tax on the sale of your company shares forever.
Wow, that might be reason right there to go this route. So Bob, very impressive that you can rattle off all that in such a concise, cohesive way. So that's why we like having you on here. So thanks for adding all that. Okay, and if there are more questions about taxes, go ahead and put them in the comments. But that did cover a lot of ground. So thanks, Bob, for adding that. Okay, let's move on to important considerations. So we're going to touch on financial analysis, structure, risk, and other considerations. So let's take a look at this now.
So financial analysis, we've talked a little about that. There's personal financial analysis and business financial analysis. So the first step, again, always is, what is it that you need in proceeds to live out the rest of your life? With an ESOP, it's really interesting because when you go back to that earlier slide where we have the gap, and the gap can be filled by ongoing proceeds or by proceeds from sale. With an ESOP, it could be both, because an ESOP allows you to sell as little or as much of your company as you want. And so let's suppose that you need to fill that gap and you want to fill some of it with cash and some of it with ongoing income. Well, then you don't have to sell all of your company. You could sell 10% or 20% or 30% or 32%, whatever you want to sell, and get the proceeds from that sale. But you would still, let's say you sell 30%, you still own the other 70%. And so when the company's earnings are distributed and you distribute pro rata by shareholder, the ESOP owns 30%, it gets 30% of the distribution. And you own 70%, you get 70% of the distribution. In addition, it allows you to maintain your position in the company. And so unlike most sales, if you sell to an outside third party, they may not want you around in the future. And so you get your cash and you walk away. With an ESOP, you can decide. If you regain control of the business, you can still employ yourself. So you can have a salary and distributions. And so the financial analysis is a very different analysis when it comes to looking at ESOPs than it is when it comes to looking at other kinds of transactions. The other piece here, when I talked about company financial analysis, is what can the company support in debt? So ESOPs can be leveraged ESOPs where you borrow money from a bank, or you can hold a note. And oftentimes, depending on how much you're selling, owners might be required to hold a note because a bank won't finance that amount of the business. And so understanding how the company pays back those notes is incredibly important, because there's not an outside buyer here. right? And this flows into the risk piece. If you're holding a note, you're taking ongoing operating risk in the company because the company's cash flows have to pay that note back. And so when thinking about risk, it's very different than the kind of risk that you think about when you're selling to an outside party, because the risk there is just the risk that the company or that the transaction doesn't close. Generally speaking, you get cash for your stock or for the assets of the company. With an ESOP, oftentimes you'll take back debt. And so that leads right into structure. An ESOP can be structured almost any way you want to structure it, at least the financing of an ESOP. The ESOP as well, the trust that buys the ESOP shares can be structured in a variety of ways. Now, there are some guidelines around that. You can't go sort of off the reservation and create something that benefits you without benefiting the employees. So the Department of Labor is very involved in setting up the regulations around how ESOPs work and how they're structured. But with that said, there's certainly a lot of latitude within those guidelines. And so what you're doing is you're creating a friendly buyer that will stand as a ready buyer at all times in the future. And so if you want to sell 30% of your shares today, and you can get bank debt for that, then you get the cash for that 30%, and you might be able to defer the taxes on that. And then you decide in a couple of years you want to sell another 20%, or let's say 19 because you want to stay in control. You can do that, and the ESOP will buy those shares at any point in time. The issue around what the ESOP will buy and the structure is that the structure could change. So, and the value can change. So let's say you've sold 30% in the first tranche of the transaction, and 2 years or 3 years or 5 years later, you want to sell another 19%. The ESOP will buy those shares, but you might not be able to get financing for that 19% because the value is higher. Or the value might be different than you thought it was going to be because you're selling another minority interest, a non-controlling interest, or maybe just operations have changed. So the value is determined by an outside third-party appraiser. And so while the ESOP stands as a ready buyer, there are limitations on what it can pay. It can only pay what's defined as fair market value, which is a very strict definition of how you determine value. And so you might not get the same value you would get by selling to an outside party. However, the tax considerations can make it very attractive, even if you don't get the same value. So I know I'm throwing out a lot of information here, and there is a lot of information to talk about with an ESOP, and it can be very complicated. But what it comes down to at the very base is that you can create an ownership structure where your employees benefit. Remember, the employees are not buying these shares. They actually get the benefit of ownership of these shares without paying anything for them. And they become the owners of the company over time or immediately. Those shares are allocated over time as debt pays off. But at the end of the day, if you end up as 100% ESOP, what happens is you can walk away from the business. The business continues to run as it always has. Management can stay in place as it's always been. And the employees now benefit from ownership. And you benefit by selling your business where maybe you couldn't sell it before, or you wanted to sell it in a way where you could stay involved. So ESOPs are probably the most flexible type of transition alternative, but they don't work for everybody, right? Not everybody wants to stay involved, and not everybody wants to put off the ultimate sale of their company by holding a note, or not everybody wants to take on that risk. So it's really understanding what it is you want to achieve, and then looking at all of the different alternatives to see which one achieves it best. But the ESOP is one that provides the flexibility to do it over time, to do it in very different ways than other options, and might even still give you the opportunity to sell the whole business later down the line. So when I was talking about maintaining control and still working in the business, if you maintain control, you still have the ability to sell the business as well. So you could do several tranches of ESOP, have the employees become ownerships of that percentage of the owners, rather, of that percentage of the company, and maintain control. Let's say you sell 40% over time, but you own 60. And at the end of the day, you decide you want to sell to a competitor. You have 60% and the ability to create that sale. And so you can sell to the competitor. And when the money comes in from that sale, 60% goes to you and 40% goes to the ESOP for distribution to the employees. And so it can be a very powerful retirement tool, a very powerful ongoing tool for the company in its operations to provide strength. And I haven't even talked about the tax advantages yet to the company. And there are significant tax advantages to the company available. But it can also be, as a transition alternative, something that allows time and thought about how you really want to exit completely. So Susan, I know that's a lot.
Bill, Bob, I feel like we could talk all day about it. So there's so many details to go over. Sorry for calling you Bill. I'm used to talking to Bill Adams, so it's either Bob or Bill that I'm always talking to. Okay, so let's look at a question here. And I know you touched on this, but I'm not sure if you want to add any more details. The question is, how can I stay involved if I sell all the shares? Could you please address that? So we talked about staying involved if you sell some of the shares, but let's say you sell all. Can you still stay involved?
You can. If you sell all of your shares to an ESOP, typically management stays in place. And if you are part of management, you can stay in place. One of the things that drives value in an ESOP is having a deep management bench and the ability to replace management over time so that the company continues. If you're part of that and you're a key part of that management team, you absolutely can stay in place. And even if you don't want to stay in place in the business, you can become a board member in the business and maybe not be operational, not be the CEO any longer. But the sellers often stay involved in their companies for long periods of time after selling to an ESOP.
Okay, and then another question is it possible to only sell a portion of the company and never sell the rest? We're back to the word never.
It is possible to sell portions of the company and never sell the rest. In fact, some of the largest ESOP companies in the country have been around for a very long time and are partial ESOPs. And so one is a very large grocery store chain, and it's owned about a third by an ESOP, and a third by family, and about a third by management. And the idea was that they want to encourage employees to have an ownership mindset. And that company has grown dramatically, outpacing most other grocery stores in the country over the period that the ESOP has been in place.
Okay. All right, let's move on to our key takeaways. We have a slide with 3 bullet points, although we've talked about a lot on this session here, but let's hit the 3 that you want people to take away from the session.
Sure. So the one is one that is a key takeaway in every conversation about transition. It's understanding your needs is the primary driver of what transition should be about and the conversation should be about. And planning early is just critical. When people wait until the last minute, which is how a lot of businesses transition, someone knocks on the door and says, I want to buy your company. And if you're unprepared for that, you will not meet your goals. If you haven't thought about what your goals are and what the path is toward hitting those goals and objectives, then you're not going to meet them. You're going to look back several years later and say, I could have done this better. I could have done this differently. The second takeaway here is that ESOP transitions are incredibly flexible. As I said, you could sell as much or as little of the company as you want. You don't have to ever get to 100% ownership. You can maintain yourself as an employee of the business or not. You can often get bank financing. You can hold a note. You can actually gift shares. You could contribute shares to the ESOP. There are all kinds of opportunities in an ESOP that might not exist in other transitions. But with that come some complexity and some governmental regulation, right? So there are some things that you have to do in an ESOP, some things that you cannot do in an ESOP. And understanding all of that is super important, because once you enter it, it's hard to get out of it, right? This is a governmentally regulated program for the benefit of employees, and they don't want to make it easy for people to jump in and out of them and change their minds and take away that benefit. So that sort of feeds into the last thing, is understanding the benefits and disadvantages, and especially the risks. Again, with any sort of transition is important. With an ESOP, I think the risks can be significant because your repayment or your payment for shares depends on the ongoing operations of the company. And anytime that's true, you are taking the same risk that you had as an owner all along. And understanding that risk and how that risk works can really make or break the decision process. And I know I skipped this and I just mentioned it briefly, but there are significant tax advantages as well to the company as an ESOP. And in fact, if you, I'm just going to throw one of them out there. If you are 100% S Corp ESOP, so the company is organized as an S corporation, this is, and I'm mentioning it now because this is something that actually mitigates risk, especially repayment risk. The portion of the ESOP that is owned by, the portion of the company that's owned by the ESOP, if it's an S Corp, that same portion of earnings is untaxable. And so if you are 100% owned S corporation owned by an ESOP, then none of your earnings are taxable for federal income tax purposes. And that creates a tremendous amount of additional cash flow that can go to pay back the note that you typically are going to hold as a seller when you sell to an ESOP. So the tax advantages aren't just related to the seller, they're related to the ongoing company. And again, the reason they do that is they want to encourage ESOP ownership, but there's also an additional risk later. You've got to purchase those shares back from those employees for them to get the value. And that repurchase obligation can become very large. And the tax benefit helps to create the cash flow to buy those shares back. And I know I'm throwing that in right at the end when we're doing key takeaways, but the tax advantages are significant, but some of the risks can be significant as well. And some of the concept, the difficulty and the complication of an ESOP can be risky for people.
Okay, Bob, we have one more question that's kind of a technical one. It's about Rule 1202. You familiar with that, I'm sure?
Actually, Rule 1202, I'm not familiar with.
Oh, okay.
at least not off the top of my head.
Okay, all right, then we'll skip it and we can answer in the comments later. So I want to put
1202. I think 1202 is small business stock.
Okay.
And it's related to a very technical tax question related to.
The question was, does it apply to ESOPs? Rule 1202. So we can look that up and answer it.
Yeah, I'm not sure it does, but that's a very technical tax question.
Okay.
Yeah.
Okay. I know your brain is packed full of all these facts, but every once in a while we have to look one up. So, okay, we will answer that in the comments. Well, Bob, thanks so much for this session. It's been long. We're going almost 35 minutes, and thanks to all of you for sticking with us when we had our technical problems. Every once in a while that happens, but I'm glad we got it all figured out and got you back on screen here. Bob, I wanted to mention that if people have want to learn more about you and all the different subjects you talk about and write about, they can go to the website. It's comerica.com/business transition, and you have a lot of information there. So again, that's awesome. Any final thoughts that you want to mention?
Since we're talking about ESOPs can be great for some people and great for some companies. It doesn't fit everybody. When people first hear about it, they think, oh my gosh, these tax advantages sound so amazing. I want to do it. I want to do it. I want to do it. It's really important to understand all of the aspects, just like with any transition option, because not everything fits everybody.
All right. Great advice. So start having these discussions early, any business owner who's watching this. All right. Thanks, everybody, for joining us. And thanks for your great questions. And thank you, Bob. And we'll see you again soon.
Okay. Thanks.